We are live, folks. Hello, everyone. Welcome to this very insightful live session with Sandeep Tyagi. We are doing this live in collaboration with Estee Group. You can check out the Estee Group on small case, and you can also invest in their schemes via the Dhan platform. Before we get into the live, I hope everybody is doing all right. Everybody is having fun. The markets just ended over here. I hope it was a very successful trading day. Uh, by the way, we have Sandeep over here with us. I'll give you guys a quick introduction about Sandeep. Sandeep is the founder and CEO of ST Group. Along with that, he is also the board members of, I don't know, several companies. He is also the co-founder of Yantri Labs, which is a machine learning focused startup. It uses advanced techniques of machine learning, algorithms, and computer science to build solutions that can be applied to various industries. Right now, they are focusing on finance and healthcare right now. Uh, I guess, yeah, that's it. You are in for a very insightful session. Over to you, Sandeep.
Thank you very much. It's a pleasure to be joining all the customers and of Dhan, and hopefully many of you are investors in Bulla. So wonderful to connect and talk about a couple of things. One, obviously, quant investing, and a little bit about the book I have recently written. So hopefully this would be a good journey. You can always ask questions, which we will try to address as we go along, and also towards the end. Okay, let me share my screen so we can start the conversation here. All right, I presume everybody is able to see my screen. It says Building Big Gains Systematically. The name of the book that I've written is called Little Book of Big Gains. And the reason I call it the little book is because it's only 174 pages. So very quick read. You can pick it up over a weekend and get through it without a lot of struggle. And the reason for that is pretty simply that investments done systematically are pretty simple to understand, but they are difficult to emotionally implement. And we'll talk about that a little bit today. The book is in 4 parts, and I will go through today's talk as well in 4 parts. The first part is really all you need, which is how do you build your investment plan? But we don't stop there. Usually what happens is that's very simple, and people get distracted by things other than what are the essentials. And I call that the noise. So I'll talk about what are the noise elements and how to avoid them. Part 3 talks about how do you stay on the course that you have now set upon to build systematic wealth. How do you rebalance? How do you measure performance? How do you look at other aspects of investments like insurance and annuities and other such things? And then finally, we'll talk a little bit about taking it further in the book, which is about building quant models. And depending on where we are, we can touch upon some of that today and then do Q&A. Okay, well, what are the essential components of building a plan? The first one is setting the right expectations. You cannot build a good plan if you don't have the right expectations of where you're heading. And the reason I say that is most investors tend to oscillate between greed and fear. They tend to have either too much of an expectation from their investments, and we have seen recent reports that the new investors, young people who have come into the market, has grown almost fivefold in terms of people who are actively in the stock market trading, even trading intraday and futures and options. That number has become 5 times in the last 4 years. Now, that growth, particularly in the time period we have gone through, indicates that people expect a lot of returns. You know, the 5-year average return of stock market has been about 21%. So when everybody has been generated on average 21%, the expectation is you will have a lot of multi-baggers. But if you look at the data over long periods of time, generating those kinds of high returns are very difficult. So moderate your expectations and set them right. The second is we expect a lot more than happens in the short duration and a lot less than happens over long duration. And I'll show you a little bit of how that works. But you would be amazed at how sustained investment over 20, 30, 40 years can be completely dramatically different than what you would expect it to be, even for people who have a good grasp of math and the power of compounding. And then we'll talk a little bit on how to put these ideas together and build a plan. Here's a little quote. We always overestimate the change that will occur in the next 2 years. So things don't change that much quickly, but underestimate the change that will happen over the next 10 years. And that's a good segue into looking at returns and what you can build in terms of wealth over long periods of time. Now, when you're setting your expectations, how should we look at the market returns? A lot of people look at their portfolios daily. Some people have it on their phones and they check it multiple times a day. However, that is a recipe for stress. And this chart shows you why. If you look at the annual return since 2004, so last 20 years of data, the maximum and the minimum annual return has been 82% and minus 53%. So the range between the maximum minimum is 135%. That's a huge range. And you don't know which year is coming up in the next 12 months. If you look at 5-year data, that means you combine 5 years, then you kind of move forward 1 year, look at the next 5 years, move forward 1 year, next 5 years, so on and so forth. That range becomes much smaller, about a third. So the maximum 5-year annualized return and minimum 5-year annualized return has been -2 to 43%. That's a range of only 45%. Now, if you look at it on 10-year rolling basis, range is even smaller. It's plus 3% to 23%. So if you look at a 3% basis, you won't lose money. You'll always make some money. And in very, very good times, you can end up making 23% money if you look at the last 10-year data. What does this mean? That means it's dangerous business to try to predict what would be the returns in the next year, but it is much easier to predict what would be the returns over longer periods of time. And that is part of how you should set your expectations, set your goals, and also set your path to what you want to achieve. Now, compounding is a very powerful force, and I'll show you a little bit of math around this. Einstein called it the eighth wonder of the world. Here is some very simple kind of mind math. If you were investing 10,000 rupees a month and your retirement age was 65, expected return per annum was 10%, how much money would you have? Well, if you started at age 55, that is 10 years before you were to retire, you'll end up with 20 lakh rupees. So every month you'll put in 10,000. In 1 year, you would have put in 1 lakh and 20,000. And in 10 years, that would have become 12 lakhs. But there is growth of 10% every year. So net, that 12 lakh that you have put in becomes 20 lakhs. Now, what happens if you continue to save for 20 years? That's double the amount. So should we expect just double the money? Not quite. What we get is actual 3 times to 4 times the money. That 20 lakh becomes 76 lakhs almost. So it's almost 4 times the money. So the time doubled, but the amount quadrupled. Now, if I go from 45 to 35 start time, that amount becomes 2 crore 26. So again, from 10-year savings to 30-year savings, the time was 3 times, but the money is more than 10 times. And if I go from 55 to 25 saving start, then the money is 6 crore 32 lakhs. So time went 4x from 10 years of savings to 40 years of saving, but the money went more than 31x. So huge multiplier on what your saving outcome is going to be through compounding. Normally, people do not realize the power of this kind of impact that can have on your savings goal. And the earlier you start and the more systematically you build your savings pipeline, the better off and more rich you're going to become more easily. Now, let me ask a question. You can put it in the chat. How many of you invest in equities, fixed income, real estate, mutual fund, gold, some other instruments? And if all of you invest in all of them, that's great. Just put all. If you invest only in some, try to do that, and we'll take a look at the chat and continue talking. The reason I put it out there is one thing you will realize is if you're doing an investment in all these things, again, year to year, the results may be different. Some year gold may do very well. Some years real estate may do very well for your home. But over long periods of time, the most sustained way of making good returns and generating wealth is only a diversified portfolio of equities. So whether it is through mutual funds or single stocks, as long as you're carrying a diversified portfolio of equities, you will generate almost 60 to 70% more money than if you were to put it in any of the other options, whether it's gold, real estate, or fixed income. And in my book, we have an accurate chart of this going back many, many years. Now, next thing I wanted to cover is how do you put together a portfolio combining these, let's say, equities and non-equity portfolio. And the analogy that we use is the analogy of gear-based driving. So if you drive a car with manual gears, you know that depending on the driving situation, if you're driving to Shimla on hilly roads and it's raining a lot, it's slippery, it's dark, you're likely to drive in a low gear, maybe second gear. But if you're on Delhi-Jaipur highway, it's bright, it's sunny, and it's early morning, so roads are empty, then you will drive on gear 6 and full speed forward. Now, investments is like that. Depending on what your goals are, what the market environment is, what your own capability and confidence is, if you have plenty of room, you are a 25-year-old with significant earning potential and you're saving for your long term, put all your money in gear 6, put all your money in equities, and you will do the best you can for yourself. If you are a 65-year-old who has saved just enough to pay for their retirement, you need to be a lot more cautious. And maybe you need to be 60% in fixed income and 40% in equities, or even more conservative. So it totally depends on your level and ability to take risk, as well as your perception of what is happening in the market to decide how to do asset allocation. And the simplest way of doing asset allocation is allocating it between diversified equities and everything else. And that ratio is what we call how geared your investments are. Now, this is a little bit of pictorial on how to use asset allocation. And I talked about two dimensions. One is whether you have plenty of savings or less savings. And the second dimension is, do you need the money after many years or do you need it immediately? If you have saved money to buy a house and make a down payment, and you plan to buy the house in next 6 to 12 months, putting that money into equities is not a good idea, because it's quite possible that in next 6 months you don't get good return or maybe even get negative returns. And you don't want to take that risk because you need the money in 6 to 12 months. So your need is near. And if you have just appropriate amount of money for your goals, again, you can't take too much risk. So this kind of an image that if you have a long-term goal and you have a lot of savings, gear 6. If you have less savings and near-term need, gear 1. That's how we kind of help you think through what asset allocation is appropriate for you. Okay. Now, that is a simple investment plan. The best way to put that investment plan in practice, which will take all of 10 minutes for you to implement, is take a diversified index fund as your equity allocation. Take a fixed deposit or a standard fixed income product as your fixed income allocation. and do it in the right ratio that you have picked based on your situation. And that's it, you're done. That plan will take only about 5 minutes to implement. And the key thing for you to understand is that if you start with that simple plan, you would have achieved more than what an average investor is able to achieve. And you would have put in a lot less effort than what an average investor puts in for doing their investments and thinking and talking to people and reading blogs and so on and so forth. So do less, get more. Very simple plan is in place, but we can't stick to it. What is the reason? The reason for that is this quote from Walt Kelly, and says, "We have met the enemy and he is us." You are your own enemy when it comes to sticking to a good investment plan. And the analogy I use is sticking to a diet. We all know how to eat healthy, a balanced diet, balancing between protein, carbohydrates, and healthy fats, and maintaining an active lifestyle. We all know that. We have heard that a million times. But are we able to do that? The answer is no. And why? Because one, temptation, we get all these wonderful little nuggets or hints or tips, and temptation is everywhere. Similarly, we get all these information and news about this wonderful IPO or this wonderful little tip that somebody has given, which is a multi-bagger stock, and we get distracted. And we are always on lookout for these superfoods. If we drink methi water at 6 a.m. in the water, suddenly we will be perfectly healthy. No, there is no such silver bullet in investment or in dieting. You have to follow a good regimen systematically over long periods of time. And you have to avoid things like the noise that I'm going to talk about. So, second question for you: how frequently do you check your portfolio? Now, if you check it daily or multiple times a day, the question is, are you really adding any value to your portfolio investment journey? If you do it a lot less frequently, as much as a yearly, wonderful. You are not getting distracted by anything. You have done your work, and you're letting the money do the work for you instead of constantly chasing and trying to tweak it. There's a very interesting story in the book I've written, which is about the Fidelity fund called Magellan. Magellan was one of the most successful funds ever. Peter Lynch was a very storied investor. And Magellan ran for more than 25 years. It generated 24% annualized return for its investors over the life of the fund. However, an average investor in the fund uh, lost money coming into the fund and leaving. The reason for that is performance chasing. People used to come into the fund right after there was a wonderful, wonderful top of the chart performance by the fund. So they would come in when the fund had done very well. And then sometimes the fund would not do very well the following year. And then people would leave, and they would leave at loss. And that is the story with more than half the people who invested in this fund. As a result, while the fund had 24%, average investor lost money. And that's the risk of performance chasing, too much trading activity, too much attention to daily, intraday, or short term movements in the market. Now, what are some of the other noises out there? I'll talk about a couple of more. One is called the availability bias. The other is called our own emotional journey, the internal noise versus the external noise. So here is a little pictorial for you. If you invested in a stock that was at 10 rupees and it went to 20 rupees, you would be super happy. But if you invested in a stock that was at 10 rupees, went to 30 rupees, and now is at 20 rupees, you are not going to be that happy. The end result and the starting point are the same, but the journey has had a major impact on your amount of happiness. This is a good example of noise. Now, why and how to control that, we'll talk a little bit about, and how to avoid these things. Another source of noise is what's called a familiarity or an availability bias. We tend to be much more interested in things that we have heard about, we have read about in our blogs. And even though there are 500 companies in NSE 500, which are investable and good companies, But we tend to focus on 5, 10, 20 companies on which we keep hearing about all the time in social media, in our WhatsApp groups, in our chat groups, and other sources of information that we are consuming. Now, one example here is this is a little bit of a ridiculous example. I don't know if you guys remember, but there was a very famous song called Gangnam Style. When this Gangnam Style song came up, the singer, whose name was Psy, his dad used to run a company called DI Corp. And it was in popular news all the time that Psy and his family and connection to DI Corp. And during the popularity of that song, the stock went up 800%, eight bagger. Was there anything changing in the business? No, not at all. But people became very familiar with the stock. They started hearing about the stock and started associating the success and the popularity of the song with the attractiveness of the stock. And it resulted in a completely irrational behavior in terms of the market price of this stock. Now, we talked about another of these noises that's called loss aversion. So there is a very famous economist, behavioral scientist called Daniel Kahneman. He's no more, but he got the Nobel Prize for doing this research. And he did a lot of experiments where he said that people get about twice the pain from losing some amount of money than the amount of pleasure they gain from gain of the same amount of money. So if you lost 100 rupees, you feel twice the pain than if you gained 100 rupees. Now, how does this impact in day-to-day trading? So if you have bought two stocks, one stock is up 10 rupees, the other stock is down 10 rupees, you're not happy, even though it is kind of even. You're getting a lot more dissatisfaction from the thing that has gone down and a lot less satisfaction from the thing that has gone up. Now, also what happens is people tend to then hold on to their losers, even though it is down and maybe there is no real reason to keep holding on to the stock. It may not be a good stock. New news has come out or something like that. And they want to get rid of some of the stocks that have gone up. As a result, they end up having holding on to the loss-making stocks very long and not produce good returns. So how this plays out is you read about some stock, the stock is rallying, so you invest. But when it falls, you don't want to readjust your portfolio. So you say, oh, I will wait till I recover my loss. And as soon as you recover the loss, you say, thank God, I've recovered, I must exit. But then the stock keeps going up, and now you are chasing the stock and buying it at a hyper price again. So your journey started here when it had already rallied, ended here when it had dipped and recovered, and you missed this whole journey from here to this high point. This is the difference between systematic and consistent investing and performance chasing. And this kind of behavior is what we have to avoid if you have to become a good investor. Now, here is a question for you, a mind exercise. You have invested in stock at rupees 100. You are expecting it to grow to 110 in 1 year. But after 3 months, the stock is down to 90. What will you do? Would you say, oh, I really didn't know much about this. The stock picking is bad. I will exit at 90. You will wait till you recover the loss and exit at 100. Or you would say, I'm very convinced that this is a great stock. It was great at 100 and at 90, it's even better. So let me buy more. Which of this would be your mindset? And it defines what type of an investor you are. You know, there are famous stories and lots of interviews of Warren Buffett talking about if I buy a stock and it falls down by 10%, I'm happy because I can buy more of it at a cheaper price. But that's not the story with a lot of the investors. What they do is they get concerned about stock price movement day to day and change their decision based on what they find on small changes in the market price. Okay, changing gears. So now we've talked about in the first section how to put together a basic plan, how to do asset allocation. how to mix between a diversified portfolio and a fixed income portfolio. We've talked about what type of noise and market distortions to avoid. Now I'm going to talk about how to stay focused on your portfolio and stay systematically invested. Two things: measuring performance and rebalancing. Now, when we measure performance, what one thing I find very surprising is a lot of investors know about their returns. They also know about their losses, less frequently, but they know about it. But they don't know about the risk they took. And if I were to simply say, here is one fund manager who's produced 10% return last year, here's another fund manager who's produced 20% return last year, which one is a better fund manager? Most people will say the second fund manager, which produced 20% return, is a better fund manager. But now let me say that the first fund manager was only investing in fixed income securities, where the average FD returns in the country has been 7%. And the second fund manager was investing in, a Nifty 50 stocks and produced 20%. Here, the first fund manager has been able to produce 3% more than what is the comparable benchmark. And the second fund manager, particularly in the last 12 months, has produced only half of what the index has produced. So even though the first fund manager has produced less than half of the second fund manager, is a much better fund manager for the investment risk he's taking. And I urge each one of you to know what is the risk you are taking in your product and then assess whether you are doing well in terms of generating returns or not. There are a couple of ways of looking at risk. One is called maximum drawdown. How much money could you lose if you had a worse expected outcome? So it's not like something that has never happened before. These kinds of things have happened before, and what could happen? So if you're investing in stock index or in a mutual fund, and if you expect that you'll never lose money, you are just fooling yourself. It's not possible. It has never happened. It will never happen, no matter what the fund manager or your friends have told you. So you need to know that this thing can lose money, but how much? Now, bird diversified portfolio in 1 year could lose 52%, as I showed you in the first slide. So it's a very big drawdown potential that you have depending on how you invest. The second way of measuring risk is standard deviation. This is a mathematical concept. You don't need to understand how it works exactly in a formula. All you need to know is the day-to-day variation of your return is what is called standard deviation. Deviation simply means how much does it change. So something that is going like this all the time has a lot of standard deviation. And something that is kind of straight going every day, a little bit up, little bit up, little bit up, doesn't have a lot of standard deviation. It's a very stable return. So same outcome, but one going like this versus one going straight. The one going straight is considered a much less risky product and a much better product. So these are the two concepts you need to know in how you are measuring the performance that is being delivered to you. Now, a question. I think I covered a lot of this already on benchmark, so I would not spend much time on this. But let's talk a little bit about rebalancing. Why does rebalancing matter and when should we do it? This is a question I get all the time when I talk to investors. Usually, the question is about market timing. Is the market too expensive right now? Should I sell? Should I get out of the market? And the reality is there is really nobody who can predict what is going to happen in next 1 month. Yes, we know that the stocks are expensive right now, relatively speaking. But can we have another 6 to 12 months of continuous upgoing and very good returns before a correction sets in? Yes. Is it possible that in the next 1 month we can have a big correction? Also possible. And it's very, very difficult for anybody to professionally predict which of the two things will happen. So what to do? Well, one thing that we do know works well is called rebalancing. It basically says on some regular basis, the products and investments that go up a lot, sell some of that, book your profits, and invest in the categories and areas which are not doing as well. So that your ratio, the first concept of driving in the proper gear, stays where it needs to be. Let's say you're driving in 60-40, which is what your allocation is, 60% equities and 40% debt. And let's say after 1 year, the debt return was 5%. So 40 has become 42. And the equity return, let's say, was 50%. So that 60 has now become 90. So your ratio is no longer 60-40. Your ratio has become two-thirds, 66% and 33%. So what you need to do is sell some of your equities and buy some of your fixed income to bring it back to 60-40. That's the concept of rebalancing. It should be done roughly at least once a year, and you should keep re-looking at your asset allocation and adjusting your portfolio to see what has happened. This does benefit long-term investments. Over 40 years, there is plenty of analysis which shows that this produces much better returns than not rebalance. Okay. We talked about this. Okay. Now I'll talk a little bit about some in-depth topics. Two topics we have picked here. One is called thematic investing. The biggest investment categories in the last quarter in mutual fund industry have been sectoral and thematic funds. They have received tremendous amount of inflows, lot more than large cap, even more than multi caps. But thematic and sectoral funds are the big winners. Now, what happens in a thematic or sectoral fund is investor is still responsible for picking which sector or which theme to put money in. Let me show you some data. You could be saying, oh, green energy is big. Electric vehicles are hot. Rural banking, growing middle class, housing boom, gaming, exports. Any of these themes could be very attractive and could have worked very well. Defense was very hot till last month when it corrected 40%. So suddenly what was hot became not so hot and created a lot of losses for people. Now, the issue with picking the theme is you need a lot of high effort to get it right. You need specialized knowledge. You need the ability to track it regularly. And themes tend to go in cycles. They don't continue on top all the time. And there are too many themes, too much noise to track properly. Now, you can do a mind exercise for yourself, which of these will do well. And then you go back and look at the last year's 12 months data, and you would be surprised which ones produce good returns. Here is some data for various sectors and how they perform. Now, there is a lot of information on this page. I don't expect you to be able to consume and understand this fully. But what you can get is look at the colors. Each color represents one sector. Is there any pattern? Can you say which color is better than the other color? Not really. 2023, real estate did extremely well. It was number one area. Consumer discretionary was number two. Utilities was at the bottom. But for 2 years prior to that, 2021, 2022, utilities were right at top. So what can you make out of this? Can you really understand how these things move up and down? You have the understanding and ability to predict what is going to happen in next 1-2 years, or even whatever the duration that you're going to hold. My contention is very, very difficult to do this. And the success of thematic and factor-based fund is really dependent on performance chasing. People looking at what has happened in the last 6 months, quarter, and just pouring money blindly into whatever has worked, assuming that that will continue to work. Now, there are also some single factor funds, like momentum is very, very popular. And people like to invest in these kinds of products and funds because, they've done well. And momentum has done very well in last 12 months. Index has done 41% and momentum has done about 63% in the same time period of 12 months. So fantastic results. So you wouldn't be wrong if you said momentum is a great factor. And actually, if you look at all the different factors between momentum, volatility, quality, and value, momentum is number one factor for many years. Except if you look at a couple of these years, like 2022 or 2019, it's not that great a factor. It was middle of the range in 2022 and kind of bottom in 2018. So sometimes it does very well, like it did for 4 years from 2014 to 17. and sometimes it doesn't, like 2018. So this thematic and single factor model have this issue of picking the right horse. Meantime, you do have the ability to invest in all the horses simultaneously. And of course, if you pick the right horse, your winnings are high. But if you pick the broad set of horses, you will still do very well. And you should carefully assess whether you have the ability to actually pick the right horse more often than the average horse. Here is a checklist of what we have talked about. Number one, set the right expectations. Know what returns you can generate by investing in what types of products. Number two, evaluate your risk tolerance. We talked about gears. Number three, select the right asset allocation for your level of risk. Number four, select the right securities or products to implement your asset allocation in fixed income and equities. Number five, pay attention to transaction cost, expenses, taxes, and other fees that you may be paying to advisors or other managers who you're using to do your investment. They have a big impact. Returns are uncertain, fees are not. You will definitely pay all the costs and taxes that come your way. Do not try to time the market, and do not believe anybody who tells you they can help you do it. It's very, very difficult. We have a team of 120 people, a lot of researchers, and the results are mediocre, to say very generously. Rebalance your portfolio to the desired asset allocation periodically, maybe once a year. Don't pay much attention to thematic investment advice. Don't use real estate or gold as part of your regular savings and investment portfolio. Both gold and real estate ends up being also emotional investments. People feel safe living in the house they own. They also feel safe buying some gold. Now, if you are consuming it in other ways for emotional well-being, no problem, do it. But if you look at logically and practically what are the returns from these portfolios versus what are their drawdowns, real estate is very illiquid. It's very concentrated. You buy one house, that is the house you have. If something happens to that location, it gets crowded or a bridge goes next to it, the value will drop. It's not easy to sell. If you wanted to take 10% of the money out and do something else, you can't. So these challenges are there in these asset classes, and the returns are not there to really compensate you for that. And then protect against specific risks. We haven't talked about this, but there are some very specific risks, like health risk, or if you are an earning member in your family and your family members depend on your income to support themselves, then having a life insurance is a very important specific risks that cannot be helped by simple investment. You need to invest in an insurance product. Similarly, annuity is an important insurance product for people who are of certain age. Because if you are 65 years old, the average age of a 65-year-old in India is 80 years. But there will be some people who would live to 90 or longer, and there'll be some people who would not make to even 75. And that issue, I think we have to understand how to protect against that risk, and that can be done through annuities. That brings me to the close to the end. This is the book. It's available online on Amazon.in. It has received some good reviews from people in the market, and I would be delighted for you to get the book. If you have any questions, feel free to reach out to me on Instagram or LinkedIn or any of the social media channels that we have, and we are happy to answer any more questions. This is the product that we work on with Dhan, which is Gulla Gear 6. The 3-year CAGR on that is 47%. It has been doing phenomenally well. I think last 12 months is up more than 60%, probably 68% or so. So it's been doing very well. Again, that's not the market expectation, but the markets have been good for it. So with caution, you should select where you want to invest. There is a discount specifically for Dhan investors called Dhan 15. So feel free to use that. And now I will turn it on for Q&A.
Awesome, Sandeep sir. Very, very insightful session. We have received a few questions as well. Devesh has actually asked a lot of questions. I'll take them one by one. You can answer them. The first question is, Devesh is 25 years old with 60% of his allocations in equities. He is thinking if he should keep it constant or increase the allocation.
So, Devesh, we talked a little bit about that. It depends a bit on your earning capacity today versus your expense. So, if you are 25 years old and you are earning a lot more than what your expenses are, which is great. By the way, a young person, a 25-year-old, should probably be in about 25-30% savings rate. So, whatever you're earning, if you're putting away about 25% of it in savings, you're doing well. If that's what you're doing, then you are better off by having higher allocation to equities because your savings period is very, very long. So that is going to get you the best outcome over the long periods of time.
Awesome. He also wants to know that compounding works wonders, but how can one account for taxation?
Well, you have to factor that in. If you put it into an Excel spreadsheet and you kind of like put in the tax rate that you're going to pay, whether it is long term, short term, you can still figure out what is your return post tax. And it's just change in the rate of growth. So if it's 15% and you are getting long-term capital gains, which is today 12.5%, you are still making, somewhere around 12%. So you're compounding at 12%, and the same math roughly will pan out where the longer the time period, the multiplicative effect is higher and higher. Now, if you keep your investments simple, if you've only bought, let's say, S&P or NSE 500 mutual fund, and you haven't had to sell it, there is no tax. If you're doing individual stock trading, you better be generating significantly higher returns to pay for taxes and then still grow. So you are absolutely right. This has to be factored in, but it can be put into the same calculation to understand how you're going to compound your money.
Understood. There's a question from someone. They are struggling with the psychology of investing. I think this was put in the chat box after you took the how often do you check your portfolio? So how does one tackle that? How does one resist the urge to check their portfolio daily? Because I am also an investor. I also check my portfolio, say, 3 times a week.
Understood. This is obviously a big challenge for everyone. Information has become ubiquitous. We have all become addicted to our phones,
Mhm.
and we use that all the time. The I run a investment and trading firm. I don't look at any information intraday. I look at the reports that all our strategies have done once a day at the end of the day, and some days when I'm traveling, I may not even look at every day. I think it's like most things, you have to become aware of the benefit you're getting by doing something. If you were to say, well, I checked it 3 times a day, but did I do anything with that information except causing stress to myself? Then maybe your behavior will automatically start changing. There is also a question here about Hindi, or at least a comment. Of course, I've just seen it. So if there is a specific question that you want me to address in Hindi, I'm happy to do that.
Awesome. Awesome. No, I think that covers pretty much it. I also had a personal question that I wanted to ask. Uh, I have this feeling that long-term investing, this is like a hypothesis that comes into my mind. I have a feeling like long-term investing has actually taken a hit because of the rise of digital apps. Because now what you can really do is just with a few touch of your fingers, you can actually buy or actually sell any stock. So say you purchase stock A today, you can hold it for 3 days, a week, or whatever. You can get some decent returns, and then you can sell it. So the actual the long-term investing that we talk about, it's a sort of dopamine effect, right? Because every day you are on your phone and you are tapping away. So you get that urge to actually sell the stocks. So you can't really invest for the longer term. And with investments has become very, very easy because of these newer age apps. But also like long-term investing has taken a hit. And that is purely because we get the urges to actually sell.
Yeah. And I think the question is, on what basis are you deciding to buy or sell?
Correct.
If you are basing your buy and sell on urges, you're absolutely right. The easier it becomes, the more people will trade and buy and sell constantly because urges change constantly.
Correct.
Now, if somebody was basing their buy or sell decision based on something that they have fundamentally learned about stock market,
Hmm.
then maybe it won't change that fast. For example, knowing that stock market on average produces 15% return is something doesn't change day to day. Today, market may go down 1%. I still will believe what I just said. Tomorrow, it may go up 3%. I would still believe the same thing that I just said. So, my belief, core understanding of markets don't change day to day. If you're investing using that type of knowledge and understanding, and by the way, that's why I've written a book, not a tweet. If you're basing your understanding and investments on things that don't change day to day, then you would not have to worry about it 3 times a day. You would not have to constantly buy and sell because you are like a ship going in the ocean and small waves left, right would not make any difference.
Awesome. Correct. So I guess Sandeep, so that's it. That's all the questions we have for this live session. I hope for everyone watching, this was as insightful as it was for me because I personally learned a lot of things over in this live session. Thank you so much, Sandeep sir, for taking your time out, and we hope to do this more. Dhani,
Pradeep and Ash Pikachu, if you have आपके पास अगर हिंदी में कोई सवाल है तो आप डाल सकते हैं and I'm happy to answer.
okay, awesome. Then users, please use the coupon code Dhan15 to get exclusive access on the Good Luck Small Case, and we hope to do this more. Thank you so much.
Thank you. Bye bye.